If you own a rental property, then you know filing a tax return for an income property in Canada can be a difficult process. In this video, I will discuss the 5 steps involved for preparing your tax return for your real estate investments. Number 1. Complete Form T776, Statement of Real Estate Rentals. Form T776 is used to report the income and expenses related to your rental property for tax purposes. It's an integral part of your tax return. The net income from your rental property, calculated on Form T776, should be entered on line 126 of your income tax return. Number 2. Calculate expenses. The following criteria must be used when determining which expenses are deductible. Number 1, the expense should be incurred for the purpose of earning rental income. And number 2, the amount of the expense should be reasonable. Now that you know the tax form to complete for your rental property, you must review your expenses to determine what you can deduct from your rental income. The most common expenses that are deductible from rental income are bank charges, insurance, maintenance and repairs, and utilities. Number 3, determine rental income. The next step in preparing your tax returns for rental properties in Canada is to determine the gross rental income. The gross rental revenue that you earned in the year must be reported on Form T776. Gross rental revenue earned is equal to the amount of rent payments that you've received in the year, less prepaid rent received. Prepaid rent is not rental income, but is a tenant deposit that you're holding on to, usually to be applied against the last month's rent. Prepaid rent is only recognized as revenue when it is applied to the month to which the prepaid rent relates. Number 4, claim capital cost allowance. One of the most important tax decisions that you need to make is whether to claim capital cost allowance, also known as tax depreciation or CCA. CCA is an annual tax write-off, calculated as a percentage of the cost of the property, excluding land. The following CC percentage rates apply: 4% for residential properties, 6% for commercial properties, 10% for properties used in the manufacturing industry. The advantage of claiming CCA is that it reduces your taxable income from the rental property. The disadvantage, however, is at the time of the sale, all of the previous CCA claimed must be recaptured into taxable income and is therefore subject to tax. Number 5. Calculate the gain or loss on sale. The last step in how to prepare tax returns for rental properties in Canada is to calculate the capital gain or terminal loss. When you sell your rental property, you'll either have a capital gain or a terminal loss. Half of the capital gain is taxable. When there is a loss on the property, it is recognized as a terminal loss and entered on Form T776. It is fully deductible. A capital gain is reported on Schedule 3 of the tax return and is also entered on line 127 of your return. The capital gain is calculated as follows: the sales proceeds after commissions and legal fees in excess of the original cost of the property, plus improvements. Thank you for watching. Please remember to like, comment, and subscribe. Also follow us on Twitter and Facebook for more great tips and tricks. Thank you. See you next time.